Everyone knows that having good credit is advantageous, but building credit while studying full-time can seem impossible. That's why we have gathered tips to help you build credit while in college.
To start building credit, first understand the basics of how credit works. Obtain a credit report maintained by one of the credit bureaus, Experian, TransUnion, and Equifax, as it will contain data on your current and past debts, payment history, residential history, and more. The information contained on your credit report determines your credit score. The higher your score, the more attractive you'll be to lenders and creditors. Get a credit card. Credit cards are one of the best tools around for building credit, but you may have trouble qualifying for one when you have no credit history. Luckily, there are a few credit card options for people with little or no credit. If possible, become an authorized user. If a friend or family member who is willing to add you on as an authorized user onto their credit card, you can piggyback off their credit activity to build your credit. Even if you don't directly use the card, the account can still land on your credit report and boost your credit score. However, keep in mind that there are some risks involved.
Another option when first starting out is a secured credit card. This is a cashback card which has a limit equal to the deposit amount. You use this card like any other credit card. The deposit is used in case of any missed payments, but you do get it back once the account is closed if your payment history is in good standing. There are three main factors when choosing a credit card: the APR, the perks that you will get when using this credit card, and the credit limit, how much you can spend on the card per month. A standard beginning APR is around 20 to 24%, with most companies offering an introductory rate of 0% from 6 months up to 1 year. However, missing a payment might cause you to lose your introductory APR, so be careful. Some examples of extra perks or bonuses a company may use to get you to sign up for their card are cashback bonuses, good student bonuses, frequent flyer miles, and even $50 off towards your first billing cycle. While you can't predict what your credit limit will be for every card, some cards do have estimates on what their average limits are. This might be important to you depending on what you get your card for, whether that be business or personal expenses.
Number 1. A low credit score can make you seem untrustworthy with your money. This doesn't just affect the way you look to banks, but companies you're planning to do business with. Your cell phone provider, insurance, and utilities may worry about your score and charge your fees at a higher rate just in case. Number 2. When you're planning to get a home, it will benefit you. Landlords want tenants to have good credit scores, and if it isn't great, you can miss out on an opportunity of your dream home. If you're not sure about being able to afford a home, you can always use the rent-to-income ratio. Number 3. It affects the interest rate on your mortgage. The higher your credit score, the better your interest rate on your mortgage will be. When having a low credit score, it basically shows that you can't afford to buy a home. I'd advise to build on your credit score before considering making a big purchase. Number 4, it determines whether your loan gets approved. If you're trying to get a private or auto loan, it requires you to have a good credit score. Your credit score is the biggest factor in determining your loan rate. It's still possible to get a loan, but you're more likely to have a higher interest rate because of it. Number 5, it changes the way you pay for things. Good credit score can get you pre-approved for credit cards that can offer reward points or cashback offers. When you have a low credit score, it shows that you have a low credit history. Lenders can decrease your limit if you don't make your payment on time. Having good credit allows you to open doors to get things you want, make you financially aware and responsible.